Silver fell to $90, and then dealers collectively went dark. Was this coincidence or intent? If this were merely a routine price correction, why did JM Bullion suspend trading? And why did the London market fall nearly silent at precisely the moment of peak panic? When price charts turned red but physical purchasing channels vanished, what exactly was obscured from view? To answer this, we must return to publicly available data, historical precedents, and the mechanics of market structure to understand what is truly unfolding in silver, gold, and the US dollar. Immediately following the sharp decline into the $90 range, the silver market entered a condition many investors described as suffocating. Not because of the red numbers flashing across electronic screens, but because of the paralysis that set in when nearly all avenues of execution closed simultaneously. The silence of dealers at the exact moment when buyers were most motivated transformed the discussion from one of price movement into one of system functionality. Markets do not truly break when prices fall. They break when liquidity disappears. What made this episode particularly striking was that liquidity vanished at the very moment it would normally be expected to surge. To grasp what was taking place, observers must slow down and examine the days preceding the drop. Any abrupt move, when stripped of its context, appears as a shock without cause. In reality, major trading hubs had already recorded a noticeable acceleration in physical silver purchases, particularly in regions where silver is traditionally viewed as a defensive asset during periods of US dollar instability. Public disclosures from several vaulting facilities indicated that silver outflows exceeded inflows. This points to the presence of sustained, and in some cases slightly increasing, real demand, even as derivatives prices continued to fluctuate aggressively. Seen through this lens, the drop to $90 becomes difficult to explain using conventional trading logic alone. Under normal conditions, sharp price declines tend to attract physical buyers who act as a stabilizing force. Yet in this instance, instead of a rebound driven by demand, the market fell into an execution vacuum. Retail dealers temporarily halted sales. Listing systems at certain international trading centers experienced disruptions, and buy orders, which should have intensified, could not be processed. This sequence does not suggest weak demand. It indicates a system incapable of operating efficiently at the newly imposed price level. This leads to a more fundamental question. Was $90 truly a market-clearing price, or merely the price produced during a brief contraction in liquidity? Historically, asset markets tied to gold, silver, and foreign exchange have experienced repeated episodes of temporary price distortion when fiscal pressures and balance sheet constraints emerge simultaneously. Month-end, quarter-end, and year-end periods are especially prone to highly technical volatility. A substantial body of academic research has shown that large financial institutions are often compelled to adjust positions to maintain capital adequacy ratios, particularly during periods when the US dollar is under strain from expansionary fiscal policy. When these balance sheet adjustments coincide with strong physical demand, the divergence between quoted prices and the prices at which real transactions can occur may widen abruptly. What elevates this particular decline to a focal event is the degree of simultaneity involved. The sharp fall in price coincided with temporary shutdowns across distribution channels. Disruptions in London's pricing infrastructure aligned with rising physical flows in Asia. Reports of declining inventories emerged precisely as derivatives markets signaled intensified selling pressure. All of these developments unfolded within a single morning, making it exceedingly difficult for market participants to distinguish between technical dislocations and indications of deeper structural strain within the pricing system. Several international analysts have argued that when derivatives prices fall faster than distribution and inventory systems can adapt, Retail dealers are effectively forced to suspend activity to avoid inventory mismatch risk. Similar dynamics have occurred during periods of extreme volatility in currency markets, where on-screen prices failed to represent executable market reality. Viewed in this context, dealer shutdowns during low-price episodes are not expressions of unwillingness to sell, but acknowledgments of an inability to guarantee replenishment at comparable prices once stability returns. This risk is particularly acute in precious metals, where supply chains cannot respond instantaneously to price shocks. Compounding the situation, the price divergence between Asia and North America, already present for months due to differing capital flows and defensive positioning, widened rapidly during this session. In several Asian markets, physical silver continued to trade at materially higher levels than quoted prices in the United States. This presents a clear paradox. If silver prices had genuinely collapsed, why did the markets with the strongest physical demand fail to reflect that decline? It is precisely this inconsistency that has led many observers to interpret the $90 print as an anomaly within the pricing mechanism rather than evidence of a fundamental repricing of silver itself. A deeper examination reveals the critical role of market psychology in amplifying the episode. Retail investors tend to respond reflexively to visual cues on price charts, particularly during periods when defensive assets attract heightened attention amid fiscal stress in the United States and other major economies. Yet charts do not always capture the full reality of transaction activity. During periods of system disruption, derivatives prices can temporarily detach from physical prices, creating the illusion of a severe sell-off even as underlying demand remains intact. This is not without precedent in the silver market. Previous episodes of pricing divergence have ultimately required a corrective phase to restore equilibrium. What distinguishes this instance is the collective convergence of multiple stress indicators: falling prices, evaporating liquidity, widening regional spreads, and escalating investor anxiety. When these factors align, they force market participants to look beyond nominal prices and examine the underlying mechanics at work. For this reason, current commentary increasingly suggests that the market is entering a phase in which short-term data points are insufficient to capture the broader picture. Veteran observers of defensive asset markets recognize that major transitions are often preceded by subtle but persistent anomalies. Sustained regional premiums, prolonged vault withdrawals, or repeated execution failures. When such signals coincide with derivatives volatility, markets can enter periods of temporary repricing rather than outright collapse. This is what makes the episode so compelling. The story is not simply that silver touched $90. It is the story of a market probing the limits of its own operating framework amid a global economic environment shaped by aggressive fiscal and monetary policy. It is the story of a market in which quoted prices no longer fully represent supply and demand. And it is the story of a trading network that, at times, must pause, not because buyers disappear, but because the system itself cannot keep pace with the speed of price adjustment. If you have followed this analysis to this point, it is clear that the $90 event contains more depth than the chart alone suggests. The question, then, is whether this represents a routine month-end technical adjustment or the early signal of a broader repricing phase within silver and defensive assets more generally. Looking back at the $90 drop and the moment when trading systems collectively went dark, the dominant signal is not fear, but transition. It suggests that the market may be entering a deeper repricing phase, which is precisely why the opening question matters more than ever. Are we witnessing a collapse or a structural realignment? Within the current political and economic landscape, as the US dollar faces sustained fiscal pressure and global capital increasingly seeks assets that preserve purchasing power, gold and silver continue to serve the essential functions they have fulfilled for centuries. Short-term distortions represent only the surface of a broader movement, where historical forces and market realities intersect. This implies that what we are observing today is merely the opening act. Trading venues, liquidity models, and investor behavior will continue to evolve as the global system restructures the value chains of defensive assets. The pace remains uncertain, but the direction is increasingly difficult to ignore. How, then, might these dynamics shape silver's role over the coming decade? What will ongoing physical flows reveal about confidence in the global financial system? Share your perspective. Questions of this nature are what form the foundation of our community. This is Money Cycles, where we examine movements that appear chaotic to uncover the structural logic beneath them. If you wish to follow future analyses, you know where to find us. Ultimately, regardless of market volatility, the true advantage lies in seeing beyond the chart and understanding the forces shaping the future. And that process of discovery has only just begun.